What comes to your mind if I ask about the best tax efficiency accounts to invest your saving? Maybe you will say RSP or tax-free saving. But what if there's another tax shelter account that is even better than RSP and TFSA? Hi everyone, this is Thomas here. Better mindset, better life. We'll continue discovering the 15 secrets the taxman doesn't want you to know. In this video, you will learn the different taxes on your investment, what you don't know about the tax-free saving accounts, and going to introduce the best tax shelter accounts that you have never heard before. Yes, even better than RSP and TFSA. So make sure you stay until the end. If this is your first time here, this channel is about financial growth and to learn how money works and how you want to work with money in Canada. So be sure to click the subscribe button with the notification on for more money-related video like this one. Your support will be my biggest motivation. Let's jump into it. Investment tax in Canada is the perfect example of double tax system. You first pay income tax, then wisely invest the remaining money. But at the end, you still have to pay tax on what your investments earn. So in order to lower taxes, first we have to understand the tax system on your investment. There are three types of taxes on investment: interest, dividend, and capital gain. Interest is the money paid to you as you loan the money to banks in a saving account, or government in the forms of term deposit, T-bills, or bonds, etc. All interest earned is 100% taxable in a non-registered account, even if it's just a few dollars per year. If you earned less than $50 in interest from any account, you may not receive a T5, but you are still required to report the interest to the CRA. Dividend is where the company makes profits and pays out a portion of the profits to the shareholders. There are two types, eligible and non-eligible. Think eligible dividend is provided by the publicly traded blue chip company, like the big banks. Non-eligible dividends is like your own corporation. They have different tax rates, but for today's video, I just grouped them together. As the company already paid a heavy tax bill at the beginning, compared to interest income, dividend has a slight edge and roughly 2/3 will be taxed. Again, this is not the actual math. I ignore the tax credit part and just giving you a general idea. Lastly is the capital gain tax. If you decide to sell off an item such as stock, property, antique, any assets that creates profit, 50% of the growth will be taxed. Your principal residence and your small business are the two exceptions. CRA permits you to receive any gain tax-free when you sell your principal place, but you can only do that once a year. And if you decide to sell your small business, the first $866,000 is tax exempt from CRA. To give you a better perspective, Tom has 3 non-registered accounts and invests $10,000 each, and he's at the top 50% tax bracket. The first account he invested into term deposit, which can yield 10% interest rate. Therefore, the interest he gets is $1,000 and 100% goes to tax, so the government pockets $500. The second account he invested in the company's share that yields dividend. He also gets $1,000 for his dividend. 30% goes to tax, so government gets $300. Tom sold the stock in the third account and get back $11,000. He gained $1,000, so 50%, which is $500, will be taxed at 50% tax rate. The government gets $250. Now, depending on your tax bracket, in Canada, capital gains can be taxed at a lower rate than interest and dividend. But in general, as tax-wise, interest income is generally not the best way to invest your money. And if you can move interest investments to ones that pays dividends, you can significantly lower your tax bill. If you are conservative, instead of putting money into saving accounts or term deposit collecting interest, you can consider purchasing the actual bank's share. The return is less guaranteed, but still very consistent. More importantly, you pay less to CRA compared to interest income. But of course, the smarter way to save money on tax is to shove money into a tax shelter vehicle like RSP or tax-free saving accounts. Tax-free saving accounts was first introduced in 2009. Every dollar that you put in there is tax-free upon withdrawal, and the unused room can carry forward. You can check out my previous video on how TFSA works. is a great solution, but a lot of people are not using to its full potential. Here are the common mistakes. A lot of people got fooled by its name. The more accurate name for the TFSA should be Tax-Free Investment Account. As all profit generated are tax-free, the government encouraged people to invest into the market rather than put it into a saving account. According to the survey conducted by the Royal Bank Canada, more than 50% of people are putting their money into a saving account or term deposit in the tax-free saving. Even after 10 years of TFSA was introduced, 4 out of 10 account holders still believe TFSA are for saving and not for growing money. When you combine the growth potential of these investments with the tax-free feature of the tax-free saving, then you are maximizing the true value of your account. The other one is the contribution amount. In the year 2020, people can shelter money tax-free up to $69,500 into the tax-free saving account. However, that only applies to the people who are already 18 years old and resides in Canada since 2009. If you just turned 18 this year, you have $6,000 room to start, not $70,000. However, a lot of people forgot that part and overcontributed. The overcontribution will be taxed 1% every month, and that's 12% per year as penalty. The best way is to log into the CRA portal after you file your tax return. Lastly, tax-free saving account is considered tax-free in Canada. If you decide to move somewhere, other countries such as the States will not recognize TFSA as tax-free. They will only see it as a foreign income trust, and therefore more tax and paperwork needs to be filed. So what can you do if you have to move to the States because of job opportunity, but you're not too sure if you want to come back to Canada in the future? Or what if you receive an unexpected inheritance and you max out your RSP and tax-free saving already? What else can you do? Let's move on to the biggest secrets the taxman doesn't want you to know. Secret number 7, LITS plan. LITS is short for Life Insurance Tax Shelter Plan. In this book, the author said the best tax shelter vehicle is using life insurance. Many people view insurance as a necessary evil. But what if we could show you that not only insurance is a good thing to have in case of your death, but it could also provide you with a way to grow and use the money tax-free. Previously, I talked about how RSP and TFSA can shelter your money and let it grow within the plan. And by the time you withdraw from RSP, you will be in a lower tax bracket and therefore pay the tax at a lower rate. The life insurance tax shelter plan not only permits you to grow money tax shelter like RSP, but also permits you to take out the money without tax implication like the tax-free saving if constructed properly. So instead of just tax deferral, you can have tax-free money too. First, let's understand how life insurance tax shelter plan is set up. Each insurance company has their own unique name, but the plan basically operates like this. You participate in a permanent insurance plan that also allows you to deposit extra money into the plan. That extra portion deposited can be very flexible and can adjust anytime over the years. The younger you are, the cost of insurance is lower, and therefore you can deposit more money into the investment with the same premium. Under the Insurance Act, the money invested in a life insurance plan is tax-exempt as long as they meet the criteria described in the Tax Act, and every year they need to pass the tax exemption test. Why is this important? This illustration might help. Although the numbers will not be the same for you, it should give you a good idea of the benefits of such a plan. Suppose Henry invests $10,000 at a 10% rate of return for the next 20 years. The money will grow from $200,000 to $630,000. If it is invested in a non-registered account at a tax bracket of 40%, he needs to give $172,000 in total as tax to CRA. But if he invests in the RSP, tax-free saving, or in life insurance, then he gets to keep the full amount. Probably you're saying, this is good, but if I want to take the money out, don't I encounter the same problem as RSP? Not exactly. If you decide to withdraw the fund, you can withdraw the adjusted cost base of the plan minus the cost of insurance without any tax problem. In short, Henry in this case can withdraw under $200,000 tax-free. Next, with the balance remaining, there are two withdrawal options. The first option is straightforward and structured in the same way as withdrawal from RSP. The second option is what makes the life insurance shelter plan as the greatest tax shelter plan in Canada. Instead of withdrawing the money, you can go back to the insurance company or the bank and borrow the money you need, using the insurance plan as security. Compared to the traditional loan, this kind of loan is usually in a lower interest. The underwriting is little or even close to no paperwork, and there's no commitment to repay until you pass away. Upon your death, because the plan is a life insurance plan, the death benefit, which is the original life insurance coverage plus the fund you saved, will be paid to the beneficiary tax-free. The loan will be paid in full and guaranteed there will be leftover flow to your beneficiaries. Again, it's tax-free. The lending company will feel comfortable with this arrangement because they know the loan is well secured by the balance of the fund plus the life insurance. So they know they get paid back no matter how. So everyone is happy. For LITS plan, the limit of the tax shelter room depends on the life insurance coverage. Unlike tax-free saving, you have control the size of the tax shelter room, not by the government. And this money is flowing into your hands tax-free. In addition, in the event that you do not survive as long as the money does, because it is an insurance policy, the balance remaining plus the insurance benefits goes to your beneficiary, also tax-free. Now you see why the tfsa is the best tax shelter plan. Overall, the best tax investment strategy is still time. Let time dissolve the tax burden and grow your money. Which tax strategy is new to you so far? Tell me more in the comment below. I will put all the links down below in the description box, including where you can buy this book. And don't forget to download my 5 tips to boost your financial immune system. This is Thomas. If you want to learn how money works and how you want to work with money, then I will see you in the next video.